Welcome, guys. It's a pleasure to have you guys on Capital HQ. The purpose of today's call is really to dive deeper into a report that you guys both put together, the BDO and Focal Venture Fundraising Landscape Q3 2023. So, if Adam, if you'd like to introduce yourself.
Yeah, sure. Hi, my name's Adam, and I'm part of the growth advisory team at BDO. We are specialist earlier stage advisors helping companies raise both debt and equity, post-seed up to early Series B. We're a mix of both advisors and former investors in our team. So we believe that uniquely in the market, we've got a really strong investor lens when we look at opportunities. So the companies we talk to and work with are best prepared to hopefully increase their chances of a successful raise.
Fantastic. Maybe Jack?
Yeah, absolutely. I actually couldn't agree more. On the BDA side, been fantastic partners to both us, but also a number of companies that have gone through Focal. So I'm one quarter of an organization called Focal. We're essentially a central data exchange for early stage fundraising. So we were formed about 3.5 years ago by two quite senior members of the VC ecosystem that decided the process of raising funding was completely broken and very opaque, very relationship driven, predominantly favored that of the well-networked or very community-led individual and founders. So we started tackling that problem. We have a buy nor demo day, which is certainly probably Europe's largest, and we're kind of bridging on now, hopefully, with global expectations and ambitions. We see about 4,500 early stage companies every single year. And we systematically invest into 2 to 3 companies that go through each demo day by SPVs. So we've co-invested with likes of NTVC, Lightspeed, Boulderton, etc., and have facilitated, I think, of last demo day about 7,500 introductions between both VCs but also founders.
Fantastic. And I think hopefully today that we can get rid of some of this opaqueness with this report. And for anyone who's watching, in the description is a link to that report. And the questions that will be asked today and answered, and the discussions will all revolve around that report, as well as expand on it. So I think first things first, maybe one of you can answer this to start with. Considering the trends highlighted in the report, how is the dynamics between investors and startups evolving? As a follow-up to that, what key strategies should startups adopt to navigate this evolving landscape?
Okay. If you want to take that one, Adam.
Yeah, that's fine. So I think leaning on what Jack said before, is we also firmly believe that there should be more transparency in the ecosystem, and companies should be able to, if they're well prepared and well researched, to be able to go out to investors with a good proposition and be able to get a meeting. And by that, I think it works both ways, that when founders reach out to VCs, they should get a response with clear reasons why the investor wants to or does not want to take up a meeting. But also founders really need to do their due diligence, that they are going out to relevant VCs. Sometimes when we speak to companies and they say, I've been out to a few investors and I'm not really getting much traction. And we look at a company doing 10K of MRR, and they've reached out to investors that clearly say on their website they only invest in businesses that are doing 2 million EBITDA upwards. So they're not going to get a response, because investors will just look at that and say, you haven't researched this properly, you've got no credibility, I'm not going to respond to you. But more widely, I think it's becoming more important for founders to give themselves more credibility by not only knowing their business really well, but also knowing the whole landscape of businesses that they compete against, and how the market that they're operating in has changed. Because not only does that give more credibility to the founders, and especially in early stage, I think it might come later in one of your questions, but it definitely comes through in the report. Founders are the most important thing for early stage investors. So knowing your company and your market really well shows investors why you are the standout pick in your market for them to invest in. Because what you have to realize is very few investors, if any, can have two competing assets in the same portfolio. So what you're convincing them of is this is a really good market and you should invest in it. But also we are the best asset in that market for you to invest in. And the reason we know that is because our KPIs are better, our management team's stronger, our traction is quicker, et cetera, et cetera. So knowledge and being prepared. I think you'll find that me saying being prepared might be a recurring theme throughout.
Fantastic.
Yeah, absolutely. And I couldn't agree more on the investor points. Often VCs, forgive me if any VCs are actually tuning in, but are often quite fickle individuals. So as a startup, it's paramount really to, like, first impressions matter, because it's kind of what I'm trying to say. And often from an investor outreach point of view, there's only kind of one bullet in the revolver from a chance point of view, from exposure to VCs. So first impressions matter and they last. So it's kind of pivotal to make sure that you present yourself as a founder in the best possible light, whether that be to take formal advice from an outreach point of view or to structure a financial model if you're a late stage company that reflects the VC's growth expectations. All those things come into play.
Okay, fantastic. And I guess moving on to the next part of the report in terms of venture landscape and dynamics, investor dynamics. So it's reported that 42% of investors require investments to qualify for VCT or EIS funding. Apart from the tax incentives, why do you think this is, and how does it shape investment strategies? So that's first part. And how should startups navigate this landscape if perhaps they don't qualify for it, or what steps should they take to make sure they qualify for it?
So I think that the first thing to mention is that the reason that question is in the report is to set the theme for the rest of the report, so people know where the answers or the type of investors that are answering these questions. And I think what you'll find is with EIS and VCT investors, the background really to that is, if you kind of think, without being too stereotypical, UK personalities versus US personalities. UK personalities are more risk averse naturally. The background of a lot of the VC ecosystem in the UK, because it hasn't been going for as long as in the US, is more kind of private equity type mindset with a bit more risk. So those EIS and VCT aids allow the funds to take more risk, and then therefore allow them to say, do you know, we can invest in companies that are more loss making for a bit longer than our counterparts in private equity. And that's really helpful for earlier stage companies. And I think it does make it more difficult for companies that don't qualify to raise money in the UK. But I think if you consider why that is, most companies that VCs will want to invest in are high growth, early stage UK based companies. And the reason for that is, despite what we're doing now and having a virtual phone call, VCs do want to know that if something goes wrong, or they need to, they can just get in a car, get on a train and go and speak to the management team in person and try and help them. Because VCs, although people do give them a bad name, do want to be supportive, because ultimately everyone has the same goal, to get a nice return for management and the VCs. So I think what is important is when you are looking for your first round of investment, or you're coming through to the fifth or sixth year, without going into the details of the EIS and VCT rules, is to really understand and grasp those rules, to know how to keep your company EIS and VCT qualifying, because it does just open a lot more doors and give you a lot more options for funding.
Right. And
yeah, absolutely.
Yeah. Sorry, Jack, did you have something to add?
Yeah, I think just like a takeaway tip, really. There's obviously a thing called the EIS Advanced Assurance. So if founders are thinking about going out to raise through the EIS scheme, which, as Adam rightly said, is massively beneficial from a UK investor point of view. And I think having proper legal advice that you can actually rely upon to go out with that assurance is sometimes very advantageous. So we have worked quite closely in the past with a law firm called Philip Hare, which is a specialist EIS law firm. And so for any founders out there, I think thinking about that sort of strategy, it's important to get proper legal advice. And I think those guys are really good at what they do.
Yeah. Okay, those are some good tips. In regards to Adam, what you've mentioned in terms of the more risk aversion mindset, have you seen a trend where it's getting more risk averse or less risk averse? And obviously, the last 2 years probably has seen more risk averse, but in general, the UK landscape, what's your opinion on that?
So it depends how you look at risk. I think the biggest change in the landscape has been how long investors allow or will tolerate cash consumptiveness in a business. They want to see a pathway to profitability sooner rather than later.
Yeah.
I think if you look at those like Series C, Series D raises, they're the ones that have really fallen off, because most VCs now think that the companies that struggled the most and the bigger companies that were really the big failures through and out of COVID were those ones that were still loss-making, having had hundreds of millions of investment. So I think Series A investors especially are now turning around, and I think we've asked the investors these questions that where previously Series A investors would say, look, if you're not profitable in 2 years, that's fine, but as long as you start to get profitable within 2 years, we really need to see that. Now it's a lot more like 17, 18 months. We don't want to see heavy loss making throughout. And effectively what that's saying is we want to see a structurally profitable business model, that the longevity of the company isn't just dependent on spending more money on marketing, winning more customers. It's, do you have profitable customers? Are you running a strong company? So that if some other crazy macroeconomic event happens, that it's more savable, that we can keep the company going through that period. The company won't need massive investment to support, the investors won't have to support their portfolio with massive investment just to keep those companies running.
Right. And I think, based on that, on the follow-up of that, either one of you can take this on, but it's noted in the report that most Series A investors expect a company to become profitable within 12 to 24 months post-investment. From an investor's perspective, how realistic is this expectation? And from a founder's perspective, from a startup's perspective, what steps should they take to meet these profitability timelines?
I can take that one, bit of a tongue twister. Yes, obviously now startups are being launched, I think with leaner fundraising environment in mind. Obviously DD periods from investors are taking a lot longer, and they're kind of mitigating. Those are now perceived quite risky or riskier investments than previously. Teams, which is obviously a huge proportion of overhead, but other overheads I think are being kept smaller for longer, which means that profitability can be achieved at a quicker rate. I think obviously there's an offset with growth here, with VCs revising down their growth expectations to account for better inverted commas profitability. But there's also great focus on, I think, organic customer acquisition channels, customer retention, especially from a consumer perspective. So all in all, I think they're having to be much more strategic about growth and not just targeting everything and everyone, like they were, or possibly more so anyway, 1, 2, 3 years ago.
Right. And maybe follow up, and this is what impact does a higher focus on profitability maybe have on the rate of innovation then within this UK ecosystem?
I'm not too sure if you want to take that one, Adam.
Yeah, I don't mind. I think that I think it just goes back to what Jack says, that it drives more focus from management teams. If you're not trialing loads of different routes to market, loads of different products at the same time, and you have a focus to say, all right, we're going to launch this, and then we'll launch this module, and then we'll launch this module. But keeping in mind that you're not just going to go out and try and win 10 customers straight away with whatever you've got, and then you've got to maybe rebuild the tech because those 10 customers, it doesn't work for those 10 customers, and you've churned 80% of that. hopefully, does that answer your question?
Yeah, absolutely. It's and then in the report, the average minimum founder equity stake expected by investors at different funding stages was mentioned. The numbers evade me, but I'm sure you guys know them. How does this expectation influence founder decisions, and especially considering company growth and how much they're supposed to give away?
Yeah, I can take that one. I think it's a dark art, really, and it obviously involves quite a lot of negotiation.
Yeah.
It's about realistically a baseline, finding a happy medium for both of the parties mentioned. I think it's a famous saying, I'm not too sure who said it, but no amount of friendliness can change the fact that every single cap table adds up to 100%. I think if you put yourself in the investor's shoes, I think investors obviously look for founders to be incentivized round on round, right? And that's probably most important for them, beyond obviously their equity stake. So if you're a Series A company with 2 founders, for instance, collectively owning 30 to 40% of the business, an incoming investor will look for a share option pool as a part of that as well, which is often probably vested across multiple years of the cliff. And vesting periods are crucial to VCs to make sure that founders are sufficiently incentivized. I think founders often forget that equity is an unbelievably expensive form of financing. So maybe we can come on to a bit of like strategies and how to kind of balance and meet demands and supply. But yeah, I think from a strategy point of view, in terms of how to balance that equity retention piece and investor demand, there's now short-term and long-term debt options, which are often hybrid mixed with equity. So venture debt, which is often like an 8 to 12% fixed interest rate, often most popular with Series A companies. We see quite often. I think some VCs are very ownership sensitive, some aren't. I think the latter are very common at the very early stage. So for instance, you have an LP VC driven fund here in London called Cocoa, which is led by an amazing female entrepreneur and investor called Carmen. It's a micro VC, so that's $17 million. She, and these are her words, famously doesn't give a damn about equity stake, really. I think if you consider what pressure she's under from above, LPs, especially the more institutional players, are putting pressure on GPs because often they want to see consistent ownership within their particular funds into companies. I think there's obviously, in that particular case, not often a huge amount you can do to control that as a founder. And it's about finding a situation that works for both parties, like I said. And I think that derives from a level of transparency. So for instance, before signing your term sheet, I think discuss things that are going to be thrown into the equity compensation. So like a share option scheme, for instance, if you're a potential investor, make sure that that's negotiated fairly. I think as a founder as well, make sure that you don't fall victim to the share option shuffle, which is essentially putting the option pool in the pre-money valuation, which is diluting the existing shareholders and yourself as a result of that. And basically just don't undersell yourself. Like the opportunity cost of an incentivized workforce from a share option plan point of view, at the expense of diluting shares is one that investors understand, and you should be appropriately positioned for that to really motivate a workforce of yours, really.
Great.
Then the only other thing that I'd add to that is that equity stake point is a really good sense check for founders in terms of their valuation and how much they're raising. Because again, goes back to founder credibility, that if you're going to an investor and saying, I want to raise X at an X valuation, and the investor looks at it and they might say, look, I'm only getting single digit equity here, I'm not even going to carry on the conversation. So having a think about that 15 to 25% or whichever stage of investor you're talking to, as to do you think that's a reasonable amount of equity that they will want, not just that I'm willing to give away, that would incentivize them to want to carry on the conversations. And if it isn't, am I looking to raise too much, or is my valuation too high?
Yeah, makes complete sense. And before we move on to the next part of the sector trends and sustainability, I'd like for both of you to maybe give one piece of advice to founders currently raising capital. Just the one biggest piece of advice and perhaps the current climate.
Not too sure if you want to go first, Adam.
Yeah, I don't mind. I think that the fundraising process as it is effectively a full-time job for founders. And the difficulty in that for founders is that they are usually operating in a high growth business, and they are a central cog to that business continuing to grow. So if they take on another full-time job, the business is very unlikely to grow at the pace that it was growing at, and the wheels might even fall off. So if you end up going into a VC process and the business is growing, and 2 months into discussing an opportunity with the VC, and they might be about to put funds in, and they ask for your most recent figures, they'll look at them and say, wait a second, you're not growing at your 10-15% MRR, you're growing at 2% MRR. What's going on? If the founders say, well, it's because I'm doing this fundraising process, the VCs don't care. So it's about really understanding that it is a second full-time job. Advisors, of course, unbiased, do help to do that. But even if it means bringing in some fractional support, whether it's a fractional CFO, an NED, anything that can help you through that process, and you really have to understand that how time consumptive it is to fans that already have really short bandwidth.
Yeah.
Absolutely. I think echoing what Adam said as well. I mean, if you're not going to go down the third-party routes, I think it makes sense for a lot of companies, especially at the late stage, A and B in particular, where ultimately you have more stuff going on as a founder, quite simply. It's just to stay in the saddle. Like ultimately, the high quality startups are still getting funded, and there is a supply of capital out there, be it quite a lot of it is dry powder currently. It's a volume game. So ultimately, 90% plus of the replies that you're going to have from VCs, whether you have a conversation with them or not, is going to be a no, unfortunately, just to set the baseline. That they're in the business of saying no, that's quite literally their full-time job. But it takes a very relentless individual, one that I wouldn't really ever want to aspire to, just given the massive effects that it has on running your business, but also on your mental health, I would say. But yeah, like I said, it comes down to the higher quality startups are still getting funded. It's just a matter of when and who from. Yeah,
I think one of the biggest tips I've heard in my 2 years with Wholesale Investor is always a founder should always be in capital raising mode, as in they should never not be. So even if they've completed their round, they should still have this mindset, because it's a lot easier to keep going than to restart for the next funding round. Keep those contacts. Even if you're not raising, go once or twice a week to meet investors and just keep them in the loop. I think that was one of the biggest pieces of advice I heard, and I've reproduced that a couple of times to certain founders, and so some of them have taken that up, and I can see that obviously their first fundraise is always so long, but the ones that keep going, and I've worked with them for the second fundraise now, it seems like it's a lot easier to keep that going. So I think that for me was one of the biggest tips I've taken and given to certain founders.
Yeah, absolutely. Sorry, go ahead on.
Then I was going to say that it is a very good strategy, and I definitely agree that I think that if you are doing that, the numbers that you share with those VCs that you want to do further rounds should be numbers that you believe are definitely achievable. Because if you send out numbers which are shooting for the moon numbers, the VCs will always come back to those numbers. And if for some reason you haven't hit them, it's going to be very difficult for those VCs to turn around and not say, well, you said you were going to be doing X of ARR and you're only doing X. So can you come back to us when you get there? And maybe things have changed. Maybe you just were too aggressive with the numbers you showed them. So it's always good to show them numbers that you think are attractive to them, but also numbers that you can at least meet, but even better, surpass.
Yeah, absolutely. I think instead of, just don't like putting numbers on this, but instead of spending 100% of your time over 3 months doing a capital raise, it's spending 25% every month for 12 months. And that still allows the business to continue thriving. That was a good piece of advice. But look, let's move on to sector trends and sustainability. So obviously the report discusses the heightened focus on sustainability and investments. Obviously, it'd be great for you guys to maybe talk a bit about what sustainability is in this context. And after that, how is this emphasis changing the types of startups that are receiving funding?
I don't mind starting. Yeah, so I think if we're going to boil it all down to what investors do. Investors are looking to invest in businesses that are going to get them at least probably a 3 to 5 times return in the UK. That's like at a Series A stage. And the way they get the return is by the business growing to a point that when it's sold, there is enough of a market that the business will attract a good offer that means that everyone gets the return that they've been aiming for. So if you're looking at the way that the market sentiment has moved, which businesses are going to be those businesses that are worth the most in 3 to 5 years, as well as being growing, strong businesses, is also the businesses that have a social and economic conscience.
Yeah.
So there are, even if you take away the things that I'm not sitting here and saying, look, you need to have solar panels on your building, et cetera, but even having like a strong maternity or paternity policy, things like all those social aspects. Do you care about your employees? And it's not even what are you doing today? It's mapping out what are you doing today and where do you want to be?
Yeah.
And what steps are you taking to get there? Because I think that, there's a lot of organizations which are supporting this from like a free point of view. ESG VC is a really strong organization, doing a lot of good content in the space. And all the investors that I've heard, any of their talks or webinars have said, all they want to see is a plan. And they can work with you on the plan. They don't expect you to come in with a fully formed ESG policy. They want to know that you do care, and that it is part of your business, your whole business plan. You haven't just put it in because it's something extra that might help you get investment. It has to be core to what you're doing.
Not just chucking in AI and ESG.
Exactly.
and just kind of following up on that as well, it's been trickled down from LP, I think, pressures on GPs as well. So there's now a ESG focus really in place from a top level perspective that GPs have to implement within their particular investments. And obviously it's up to the GP to decide how far along to the right they want to go with that particular theme. So that's why you get a huge amount of funding obviously been put into sustainability and climate, like World Fund, for instance, is one of the largest in the world, actually. But certainly Europe, Ada Ventures, obviously most recently raising her latest fund to invest in impact.
Yep.
So that there is an increasing importance, I think, right from the very top, not just a base level.
Yeah, I think it's, for me, it'd be great to understand, whether investors are more looking at companies that have an ESG centric approach or whether they're investing into impact companies, right? So impact companies on perhaps climate tech space, or just what have you guys seen in that space? Is it more so focused on general ESG, or, are the focused investors just focused on impact, or is it everyone that's more and more focused on impact?
So I don't mind starting on that. I think it's really important to note that there are obviously specialist funds that invest in either climate or impact, etc. But the more sector agnostic funds, their fundraising strategy is still to get the level of returns that they need. Yeah. And a business that isn't growing at the rate of MRR increase or a annual increase that they need, or doesn't have the right gross profit or any other KPIs that they need to see to make the investment, just because they might be solving the climate crisis doesn't mean that it's an investable company. Yeah. So I think that's really important. Just having an ESG friendly business isn't going to get you investment. It needs to go hand in hand.
Yeah, absolutely. I think just onto that as well. There's a big toss up really in climate tech now in regards to a hardware or software enabled approach really to tackling problems. And there's a school of thought really on one side that says that reaching net zero goals really by the time frame that's just set out from a regulation point of view, it's just not possible without implementing more hardware related solutions. So that's a big topic of contention. I would say really in this particular market as well. So yeah, it's really important to actually visualize and contextualize whether you're physically imparting some benefit really into the environment from what your product does. I mean, if I see another, with all respect, another carbon accounting credit software platform, I think I might exit out of this game as soon as humanly possible. It's very saturated really in particular subsectors such as that particular subsector. So I think having a truly differentiated approach really to tackling what is the world's, certainly societies, one of the biggest problems right now is pivotal, that it needs to be truly unique. And I think the point of differentiation in that particular sector is more important than anyone in my personal view.
Yeah, I would agree with you on that one. But in regards to, you spoke about ESG, but from an investor's perspective, you mentioned LPs to GPs down, right? How are investors incorporating ESG into their investment decisions? Right. And how should startups adapt their strategy so that they're both incorporating ESG while remaining, let's say, on a growth path that maybe wasn't there prior to the ESG criteria being thought out?
I can say that one first. I just from maybe Adam can follow suit in regards to the lower level. So yeah, I think especially from a more institutional players, so the endowment funds, the European Investment Fund, which is a government institution, they have a mandate really to comply with regulators who the regulator vision is important to LPs because they obviously donate and invest the most amount of money. So like for instance, when you're raising a fund, you have to have an ESG policy really in place to be attractive to those particular individuals now. And that is an ESG policy on ultimately how you run your own business. Everything from like the day-to-day operations of exactly how you would run a business equivalent essentially, but also how to look and view ESG policies within particular businesses. So for instance, it's very rare that you find VCs investing in gambling propositions, in even if it's vaping, for instance, in smoking related products, etc. Anything that can be detrimental really to the health of a consumer or a business is really kind of seen in the eyes of a regulator, but also now an institutional investor, a big no-no. Maybe Adam can speak to the lower level of end user in business.
Yeah, I think that a lot of investors, when they're looking at businesses, are looking at kind of like red flag reporting ESG. So I think that if you carry that out on your own business first before going for a raise and thinking about where an investor might have an issue. So for example, if you're going out and saying we're solving the carbon, or let's say you're in a circular economy business and you're recycling something, and that's for the good of the environment, but the machines that you're using are very power consumptive, and you're not using solar power, then an investor is going to turn around and say, well, it's not really net benefit, so it doesn't really help. So that's a big red flag to an investor. An investor's not going to turn around and say, oh yeah, I'll definitely invest in this because it's solving an issue and the business is growing. Because on the other hand, you're taking away from one hand to give with the other hand. So it's just doing that kind of like red flag reporting in your mind. It's the same with your deck, your financials and everything. It's just an extra thing that you now need to think about that is core to raising funds.
Yeah. And I think, following on this, there's obviously the report suggests a shift in sector preferences among investors. How do you think this will impact perhaps innovation in less popular sectors, such as I think in the report, the telecommunications is very low in terms of funds deployed into, right? So what type of impact will that have on less popular sectors?
I can take this one first. I think we're actually quite keen on, dare I say, like the unsexy, overlooked industries that are typically very underfunded from a VC point of view. So the supply of capital is just not there and has not been there historically, and they're very much an untapped resource. So like prime example of this is maybe like shipping or logistics, where there's only been a couple or three unicorns opposed to the likes of fintech, where there's been a huge amount more. So I would say like, I think building a business in a very unsexy sector is actually quite a sexy thing right now, dare I say it. And there are specialist VCs that really can resonate that more well with you, essentially. And it's just about finding and doing your research, or basically speaking to a third party, such as BDO, which can help you map out an investor outreach strategy in order to make that happen. Ultimately, it's about finding, especially to benefit your own valuation and terms that you land on. It's about finding multiple horses in the race, but meeting them all at the same point in terms of the finish line. So creating fear of missing out on your round is another topic that we might come on to, but it's pivotal really in that regard.
Yeah, and I think just to add to that, it's just what's hot today might not be hot tomorrow. Just to echo what Jack said, if you are doing something which really solves a problem and you've got customers that are buying it, investors will invest. It doesn't, obviously you have to be using the best technology that's available to you, and doing the best R&D that you can do. But if you think about 2 years ago, when all anyone ever wanted to invest in was Web3 and crypto, those companies find it difficult to raise now because investors are just like, well, that didn't work, I'm not investing in that anymore. Even if you've got a really good company, if you've used that technology at your core and without it your business doesn't work, you're kind of a bit stuck. So really growing something which solves the problem that you need to solve, as long as the TAM, or the total addressable market of that market, is big enough and you are solving that problem, as Jack said, you'll get investors to invest.
Great. Now let's move on to economic climate and global trends. How is the current economic climate influencing investor risk appetites as per the report? And in what ways can startups adapt their pitches to appeal to these changing risk profiles? I know we touched upon it earlier a bit, but we could go a bit more detail. That'd be great.
I'm not too sure if we want to cut this one out. I think Adam said it was a bit too vague. I probably might agree, to be honest. I think we might put it in a bit of detail prior to that.
I think that if you just want to ask about, I think it was the second question on inflation and currency, because then we can just talk about valuation and then.
Cool. Just making a note to remove that. Cool. So moving on. How do you guys foresee the impact of global economic trends such as inflation and currency fluctuations or venture capital investment decisions? And to add to that, what measures should startups take to mitigate these macroeconomic risks?
So the main thing that we've seen through inflation is valuation, and there's lots of charts and graphs that people and data that people have brought out to explain that as interest rates go up, valuations go down, because the LPs have other places to put their money. So the risk appetite of investors mean that they're not going to do your 20, 30 times revenue multiples. And if you think about, does anyone on this call or anyone really expect interest rates to go back down to 0%? Probably not. So those founders that are sitting there and saying, I'm going to wait till valuations come back, it's just not worth waiting for. If you need the money to grow your business, you go out and try and get the best valuation you can get now, because there's more chance your business will grow with funding than without funding. And if you have to give away a bit more of your business to make that happen, then it's worth it. So I think that the biggest change is how it's affected valuations.
Absolutely. I think in late stage business as well, I think I mentioned this before, but shorter term lending options, which can obviously help with an equity sensitivity point of view. If you don't want to give too much of your business away at what you would see as an unfair valuation to, I think the likes of a few players in the space of Cap Chase, Uncapped, etc. They essentially give a very attractive, I would say, product. And it's obviously no personal guarantees, etc. So it doesn't have the scary headline views as previous loans available to early stage companies do.
Yeah.
But it's obviously not. It's at the cost of obviously not growing your business as fast as you would with a fully fledged VC round, which would obviously have a lot more capital available to that particular business.
Of course. There's positives and negatives in every different avenues anyway. So that makes sense. Look, in terms of moving ahead, we'll look at technology, innovation, and future trends. So considering the rapid evolution of the venture landscape, how might the role of traditional VC change in the next 5 years? Obviously, we've seen a lot more funds appear and emerge in the last 5 years. Is this a trend that we're going to continue seeing, or what are you guys seeing?
Yeah, I can take this one. So, like I said, I think there's a whole lot more of optionality available really to founders than there used to be historically. Like I said, obviously the short-term debt options being one of them, which has played a pivotal part really in Series A and B companies' growth, at least somewhat. And there are a number of different kind of propositions really out there. I think obviously within this particular, should we say, dare I say it, downturn of the markets, anything that can mitigate the investor's risk from an instrument point of view, especially, is quite attractive to them. So it's not necessarily an emerging fund model, but it's been around for a while and very much used a lot, especially the earlier stage companies now, is an ASA or a safe equivalent really in the US. They're being really used to accelerate processes and to get around, or to get around the way of an early stage. Often those, should we say, like risk profiles are rewarded with a discount rate. So we see a lot of ASAs which give essentially the investor the right to invest at a valuation set at a later point in time, but with a cap on it. We see a lot of those models emerging and are very, very popular, I would say. I think it's always going to be quite a opaque industry, and filling enough, it's not very well innovated industry, to be quite honest, from a funding perspective.
Yeah.
VCs like what they know, and often that's unfortunately to the detriment of founders.
Yeah, but maybe just to keep on that, if possible, how do you maybe see the role of perhaps AI and blockchain coming to, I don't know if this is a word, but de-opaque this industry, right? Yeah.
Yeah, absolutely. I think it's VC's been a pretty pivotal amount of change really with the impact of especially data analytics and AI. It's changed the landscape a lot from a sourcing perspective, especially. A huge amount of resources and money is being spent on sourcing. Currently, I think from a top-down perspective, those methods are very, very advanced. So like big thought leaders in this space are like perhaps Andre from Early Bird. I know episode 1 did a huge amount of this as well. And they often play and pick on the characteristic which is most important to them. So Adam rightly said that the only way to de-risk an investment, the earlier stage, is belief in the founder, and obviously belief in the founder derives from perhaps previous experiences. Maybe if you're a behavioral investor, maybe it's from the childhood, etc., that they've been raised from. But from a data point of view, it's often where they've worked in the past and at what position, with what level of autonomy, essentially, at the end of the day. And that's given way to models that can source extremely promising talents. So for instance, Mistral AI is a big kind of AI company on everyone's lips at the moment. They raised, I think, $120 million, a ridiculously expensive $270 million valuation. And those 4 individuals were previous engineers and product directors at Google. I think, yeah, it's pivotally changed. I think the way VC source companies, first and foremost.
Cool. And you talked about how investors put a lot of emphasis on the team, right, on the management team. Are you seeing more of a shift towards the management team in terms of as an investment criteria, or has it always been this way? Is it growing? Is it decreasing? Especially maybe let's consider this current crisis, economic crisis, and the climate we're in.
I could say this one will lead anyway, and Adam can maybe follow. I think it's just massively dependent on stage, right? I think shift has always been, the focus has always been on management teams at pre-seed and seed, because ultimately there's not a huge amount of data that a VC can base their decision off, an investment decision off. So I think that always has been, always will be the case. I think obviously when you're breaching growth rounds, Series A, B, and C, it's a different story. Obviously the people leading the business is still first and paramount, and the most important factor to consider. But a huge element of traction comes into Series A investors' investment decisions to growth profile the business. And obviously, like should we say market potential, like Adam said, some businesses are just not suited to a venture backable proposition, and often the size is just not there. I think from a team perspective, like I referred to before, it's mostly about the drive, grit, determination, relentlessness of those individuals, about their ability to resonate well with VCs, because ultimately it increases their chances of raising further down the line, and obviously increases the chance of return from a VC perspective. But yeah, I think every single VC approaches the conversation, at least focused on the founders, that they're only put on that earth or this earth to do one thing, and that's essentially to build that business in its entirety.
I think I'll just add that oddly, the importance of the management team has maybe slightly decreased because the importance of the business model has increased. So whilst it is still probably the key factor in why earlier stage investors invest, there is at least one very famous example, which I'm not going to mention for fear of getting into trouble, of a business that raised money just off the back of a serial founder. And that was pre-COVID. And I don't think that business would have become a unicorn as quickly as it did had it started raising now. Because I think that business model would have been scrutinized a bit more. If you look at that business model now, it doesn't have, didn't when it first got invested in, the most appealing investment KPIs. So I think that whilst it is extremely important, it has always been extremely important, that scale of the importance of your business model versus the importance of the founder has tipped slightly towards the business model. But as Jack says, without a strong management team that investors wants to back and believe in, you're not going to get investment.
Right. So look, perhaps if you guys have a piece of advice for early stage founders who might not have the right background or the right experience that maybe certain investors are looking for, but have a great product and believe in themselves, what should they do to make sure that they are kind of on the same level as other experienced founders, maybe repeat founders? What actions should they take?
I'm more than happy to say this one. So I'm reading a book at the moment, which actually dispels the myth that most the most successful founders really come from repeat backgrounds. So I think VCs have a predetermined idea that a good deal can come from anywhere, essentially. So they don't necessarily have to be a repeat founder or a Harvard PhD or an Oxford candidate to really gain investment. I think to make themselves more appealing is to put themselves on the same playing field as those. So there's a number of initiatives out there, including Focal, obviously, that can help surface those individuals. And our alumni have gone on to raise a huge amount of money, which haven't come from a traditional, should we say, VC investable background. And there are a lot of funds out there, including ADA, for instance, which is an inclusive venture capital fund that invests in people not with the run-of-the-mill background, investment banking, founded a startup when they were 15 and funded it, etc. So I think putting yourself on the same level for initiatives and doing your research into funds to really understand actually what they want and what they look for, I think is pivotal. I'm not too sure Adam can add to anything on that front.
No, I just think that I wouldn't worry about not having a traditional investable background, because if you do have a business and you've proven that it's growing and you've proven that the actual business is investable, it's about having confidence in yourself that there is a reason that business has got there, and whether it's you or your co-founder, you are doing something right which makes you investable. And I think sitting there before you go out for a raise and thinking, where are the gaps in my management team? Yeah. Do we have a gap from a financial point of view? Should we consider bringing in a fractional CFO before we do the raise, rather than getting to the raise and investor saying, yeah, I like it, but your finance function is not investable? are there things you can fix before going for a raise?
Yeah, absolutely. And there's actually nothing wrong with that, like showing a bit of humility, but there really isn't, like spotting the gaps in your team that you're not particularly good at. But there's absolutely no shame from an investor point of view in showing that. There just needs to be a level of transparency. And often an investor will be able to separate that of what you do know with that of what you need support on. And obviously that of what you do know and are very good at, you should make your superpower really in investor conversations to make it play to your strengths.
Yeah. I think if an investor can see that humility and that they can work with you to plug those gaps, they're automatically getting a value increase as soon as they invest, which is of massive benefit to them, but also to you as founders.
Great. Look, in terms of timing, we have time for a couple more questions. I think I'll merge a couple of them. Let's take on this technology side. So what role do you see technology playing in streamlining the VC funding process, right? Because based on the report, I think it's like 34% of investments take about 5 or 6 meetings, if some more, some less, right? That's that. And how do you think the increasing use of data analytics and AI in VC will change the way investments are sourced and evaluated? So if we break that down, the evaluation, the sourcing, the evaluation, and then the due diligence, how do you think technology comes into that and streamlines that whole process?
Just from a GP perspective or from a founder perspective, sorry?
From a GP perspective.
Okay, cool. Adam, do you want to go first, or yeah, me too?
Yeah, I think that there'll always be in VC a need for a number of meetings because the investor is backing the founders, they're backing the management team. So that's always going to be important. And the investor, to get comfortable with that, will want to ask questions on areas that they're not happy with. And they'll always have to prepare their investment committee report, their IC paper, and that will need to be thorough enough that gains the IC's backing to make the investment. So I don't think that's going away. I think where things could be made more efficient is maybe a bit through due diligence, in like things like data room compilation tools, all these things, which just means that you can be more prepared a bit faster. Do I think that there's going to be versions of AI which can help you put a deck together within the next 5-6 years? I would be surprised if there isn't. If you could take my team's knowledge and build that into an AI platform so that by the time we're reviewing a deck, 80% of it's already done.
Yeah,
I think that's eminently possible. I'm not a techie, and it's like what I say to most CTOs when I say, "Oh, surely you can just fix this? It'll be a quick fix." And you can see the look on their face going, "Yeah, it's not going to be that quick." But do I think that those things are eminently possible? Yes. Do I think that you'll eventually be able to feed some assumptions in your management accounts into an AI model, and it will come out with a financial model that's almost fit to go to VCs? Probably, yeah. I think all those things are eminently possible, and it will save time in preparation. But that human contact with VCs is always going to remain important. So the number of meetings, I don't think that will change, but the ability to get the data out and to respond to VCs' questions should be able to be sped up.
Yeah, absolutely. I think from a founder perspective, there's a multitude of tools really out there. I mean, I would mention Focal. Sorry, it's a bit of a shameless plug, but obviously we're a tech-enabled platform that can help on the sourcing investors side, but also from a VC point of view, sourcing founders side. We're not probably the first to do it, and probably definitely won't be the last. So there's definitely other platforms that founders and also VCs can use to source. From a tracking point of view, I think if you're not going through a third party like Adam, CRM from a founder point of view, from a tech angle is pivotal important to make sure that you circle around on conversations, to make sure that you are massively on it in terms of chasing, in terms of getting materials back over to the particular VC that they've requested. I think from a funding perspective is particularly an interesting space as well. There's now availability of platforms that can structure investments extremely easily. So we use Odin, which has been around for maybe 3.5, 4 years. who essentially from a VC point of view can help structure syndications, and can even now help structure a fund if you're raising a fund as an emerging GP, that can also help a founder. They can basically just go online, enter a few details from a company legal point of view, upload their certificate of incorporation, and start a fundraise where they can distribute a link where people can commit, transfer funds, etc. So that kind of closing part is very much streamlined, I think, already with the help of those individuals. Seed legals have obviously been around for an extremely long time, which can help with the documentation front to save you going for a fully fledged law firm, even though perhaps probably in part, especially if you want to get the best possible deal, is probably advisable to at least use a mix of both. I think I mentioned this before, but VCs are quite fickle human beings, so never underestimate the power of really having or putting your best front forward. So there's now pitch deck software which founders can use to help that story really resonates well, that uses AI. I think Canva, for instance, even has an AI tool. We see a lot of decks through that particular platform. Yeah. And then the kind of sourcing and AI and data analytics side, I think we might have mentioned that before in terms of how VC funds are really honing down on what is critically important to them. And most of the time that is either about talent at the earlier stage or data availability at late stage. And what I mean by that is Series A and B funds are basically just pulling data in from public sources such as Companies House, for instance, which will fit their particular thesis. So have completed a funding round before, their credit rating has changed, the number of shareholders has increased. So yeah, those large language models in particular are particularly clever. I think now are really servicing great companies, and VCs are putting a huge amount of money into investing in those. Yeah,
and I think one of the things I've done recently is specifically for B2B SaaS, because that's a lot of the companies we see at Wholesale Investor. What I did is, the new Chat GPT module where you can create your own GPT. I uploaded the best B2B SaaS pitch decks based on different VCs, and I've added the top VCs, their investment criteria into B2B SaaS into it. And just to test it, I uploaded our own Wholesale Investors, because we're B2B SaaS, into it. I'm like, can you help with the pitch deck based on all of these criterias? And it spurned something out, which was great. It was fantastic.
I know that Prezi does that as well. It's really impressive.
So you do that with, if you're a fintech company, maybe that's not an easy trick, but it's something that could take you somewhere a bit elevated in terms of the VC, in terms of the pitch deck game. Is probably just make your own GPT with the best decks in your industry and then just go from there.
Absolutely. I think Adam's right there. There's always going to be a human element which is needed, both
of course
on the VC sourcing side, but also the founder outreach side. I really think that'll ever be fully automated.
Yeah, I think it comes back to the original point, like the point we were making earlier, that the team, especially in early stage, is still the most crucial, right? So I don't think you can remove those face-to-face meetings or just those meetings in general. Look, we have maybe time for one more question. In your opinion, both of you, what is the most underappreciated sector in the VC space currently, and why? And we'll do one more question at the end, which is, or maybe you can incorporate them. What's the one piece of advice, the biggest piece of advice, I know we went on one earlier, but that you would give to founders thinking of starting to raise now?
Do you want to go first, Adam?
I'll take the second bit. Sorry.
No worries.
I don't mind combining them. So the first bit is that, I mentioned it before, is if you look at the report and you look at the companies that are raising, you look at people will say ESG, people will say fintech, people will say climate tech. But as Jack said previously, it's not what's hot now. So if you feel like you've got a solution to a problem and you can build a commercially viable business to tackle that problem and gain investment, then go and do it. If the market's big enough, you're strong enough founders, and there's a problem with a solution, go for it. Don't worry about what's hot now. I think there's two angles, which is I think why we have worked closely with Focal that is just really important for founders to note, and is one, be prepared as you can, because first impressions count. So if your deck is as tight as it can be, you know your numbers as well as you can, and the model is as tight as it can be, then that's really important. And going out to the right investors with the right message is really important. And getting those warm introductions, as much as we want to democratize and remove and increase the transparency as much as possible, there'll always be that element that VCs see so many opportunities that when they see a friendly name in their inbox, they might be more likely to answer that email. But that doesn't stop you from growing from someone who doesn't have that black book to going out and building their network. A lot of people say, go out, be confident, start writing on LinkedIn, build your network that way, ask people how you can help them, and then they'll want to help you. So, for example, like with what Jack's doing with Focal, what the whole Focal team are doing by saying to investors, we're going to bring you deal flow. Investors are coming and saying, well, we'll be more transparent then. If you're giving something to us, we'll give something to you. So it's just about being helpful. I think the whole early stage funding ecosystem is all about helping each other. And you'll find that if you help people, then people help you. It is, as much as people might give it a bad name from that point of view, I think that it is a very helpful environment.
I wouldn't really have anything else to add there, to be honest. No, it's so good. I think we kind of addressed the question in terms of the appreciation of sectors as well prior to that too.
All right, fantastic. Well, thank you both for your time today. For everyone watching this, again, in this description is a link to the report, and we'll also be including some other information, which you'll be able to find in the description. But thank you both. Thank you, Adam. Thank you, Jack. It's been a pleasure.
Awesome. Thanks for having us.